Welcome, dear listeners, to another enlightening episode of the World Economy Podcast. I'm your host, and today we embark on a journey through the annals of global finance to unravel a pivotal moment in history, the taper tantrum and its profound impact on emerging market currencies. The world of finance has witnessed some seismic shifts that reverberated far and wide. Join us as we explore the intricacies of this significant event and its implications for economies around the globe. In 2013, there was a significant event in the financial world known as the taper tantrum. This event was triggered by a change in the expectations of investors regarding when the Federal Reserve would reduce its purchases of assets, a process known as tapering. This shift in expectations had important consequences for the U.S. monetary policy and had a big impact on financial markets. The taper tantrum got its name because it was characterized by a sudden and strong reaction from the financial markets to communications from the Federal Reserve, even though those communications were in line with what analysts had expected. During this period, there was a sharp increase in long-term U.S. Treasury yields, interest rates on government bonds that are held for a long time, and increased volatility in financial markets in general. This caused a lot of uncertainty and turbulence in the financial world. Interestingly, this increase in U.S. Treasury yields also had a significant effect on emerging market economies, EMEs. These are economies in developing countries that are becoming more integrated into the global economy. During the taper tantrum, EMEs experienced a tightening of their financial conditions, meaning it became more difficult for them to access funding, and their currencies lost value compared to the US dollar. The taper tantrum was just one of several instances in the years following the 2008 global financial crisis where currencies in emerging markets lost value compared to the US dollar. These depreciations also occurred when US interest rates were rising due to concerns about inflation. To understand what caused these currency depreciations, experts looked at various factors. They considered the role of U.S. interest rates, as well as other broader factors. They also examined the impact of investors looking for higher returns and their investment strategies during the taper tantrum. They conducted a study that looked at 7 major episodes of currency depreciation in emerging markets, including the taper tantrum. They created an index to measure the strength of the U.S. dollar compared to 18 different emerging market currencies during these episodes. One key finding was that when U.S. Treasury yields went up, it generally led to a stronger U.S. dollar relative to emerging market currencies. However, changes in other factors, such as risk perceptions in the market, could also influence currency movements. They identified 2 main types of shocks: monetary shocks and growth/risk shocks. Monetary shocks occurred when higher U.S. interest rates were driven by inflation or expectations of a more aggressive Federal Reserve response. In these cases, both higher interest rates and increased risk perceptions worked together to weaken emerging market currencies. Growth/risk shocks happened when factors like the VIX index, a measure of market volatility, and high-yield corporate spreads were associated with lower U.S. Treasury yields. In these cases, higher perceived risk in the market could lead to a stronger U.S. dollar, even if U.S. interest rates were falling. The researchers also looked at other indicators like commodity prices and how the U.S. dollar performed against advanced economies' currencies to gain more insights. They found that in episodes where negative growth/risk shocks dominated, emerging market currencies tended to weaken more compared to advanced economies' currencies. This was often because falling commodity prices hurt countries that rely on commodity exports, which is common among emerging markets. However, during the taper tantrum, when U.S. interest rates were rising due to expectations of a change in Fed policy, the U.S. dollar strengthened against emerging market currencies despite lower U.S. yields. This was unusual and suggested that factors like investor behavior and positioning played a role. The study also examined the role of investor behavior, specifically the search for higher yields and investor positioning during the taper tantrum. They found that before the taper tantrum, investors were attracted to higher yields in emerging market currencies, and option-implied volatility, a measure of expected price fluctuations, was low. This made it an environment where a sudden change in U.S. interest rates could lead to significant depreciation of emerging market currencies. Overall, the study showed that the relationship between U.S. interest rates and emerging market currencies depends on various factors, including the type of shock affecting the markets. It also highlighted the importance of investor behavior and economic fundamentals in driving currency movements in emerging markets during these turbulent periods. And there you have it, fellow global citizens. We've delved deep into the fascinating world of the taper tantrum and its far-reaching effects on emerging market currencies. The world economy is a vast and interconnected web, and understanding these critical junctures is key to navigating its complexities. We hope you've enjoyed this episode of the World Economy Podcast. If you found our exploration of global finance intriguing, don't forget to subscribe for more insightful discussions. As always, I'm your guide to deciphering the intricate tapestry of the world economy. Thank you for joining us today, and until next time, may your understanding of the global stage continue to expand, and your financial insights remain ever sharp.